Joining me now is Jeff Krumpelman, Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors. Jeff, good to have you on the show this morning. Joining from Cincinnati, thank you very much. And what should our viewers know as we start this trading day following the event over the weekend?
Well, happy Monday to you. Here we go. Quite a bit of news over the weekend. And, I think that, you just laid out quite a busy week of economic data. And I think that's where, we're really focused. And we've had this plethora of either geopolitical or news on policy initiatives that can shake or move around confidence and create volatility. But at the end of the day, it's the fundamentals, the valuation levels, and the technical price trends, and this data that really drives the market. What do earnings look like? What does inflation and interest rates look like? And that's what we're really focused on. And I would say, as a good sign here, while portfolio managers and strategists have been asked to be kind of policy experts, it's very difficult for us to fall in that camp. We certainly have a network of people. It's very comforting that despite this significant, kind of news geopolitically, the market, as you said, has barely budged. It's held up well. If you look at other metrics like what did the dollar do, what did gold do, what did treasuries do, they've pretty much held their ground, very stable. And so from an economic standpoint, I think that's comforting here for the market and our economy's ability to withstand kind of these wall of worry issues out there.
Yeah, it is interesting. Oil prices not moving much this morning, Jeff. We had seen initially a little over a week ago when Israel had first struck Iran that oil prices at one point were up about 9%. In fact, what do you make of that, knowing that we could see potentially an impact on the economy if there was to be some sort of closure of the Strait of Hormuz?
Yeah, so I think, again, while it's tough to make the call and know whether this is going to broaden and worsen, again, some comforting kind of factoids are, number one, Iran would be shooting itself in the foot if it did close the straits. And I think a lot of policy experts place the odds of that happening at 50 to 60%, so well short of 100%. China, a key trading partner of Iran's, and they source a lot of their oil through that strait, that they would be hesitant to injure an ally, in essence, in China. So those are some interesting factoids. It would be a headwind, clearly, if oil spiked significantly, an inflation headwind, which is what we don't need right now in this environment. But if we look at the past, study history a little bit, you take a look at what happened right after Russia invaded Ukraine, you look at Gulf War and other periods, oil tends to spike along those kind of lines that you just talked about in terms of magnitude. But, in the case of Ukraine, two months later, oil had fallen below, pre-conflict levels and settled in pretty nicely, and it generally does that. So we just have to continue to monitor this, but no reason to call extreme, pain scenarios right now.
So in speaking of valuations, we do see the S&P 500 finishing Friday just about 3%, Jeff, from its all-time high. Does it look attractive to you as an entry point into the market right now?
Well, so I think it looks like a decent entry point. Great entry point if we were at 14 or 15 times, earnings with a strong economy. That's great. But this is, a healthy level. We've been hold your ground, hold your asset allocation levels, and, as active stock selectors, portfolio managers, we find that while you've got a group, Mag 7 and the more growth-related stocks trading at, close to 30 times, and they've recovered and almost gone back to all-time highs, There are 493 stocks out there that are trading at 17 times or below, and we find some very attractive opportunities that are not at the levels that you see in these higher price growth stocks.
What are some of those opportunities that you think could be fruitful down the road, Jeff?
Yeah. So we really like the industrials right now, particularly those that are tethered to building out energy infrastructure. We really need to build out the grid, and we've got all this demand coming from data center and AI related demand for electricity. So, stocks like GE Vernova, Eaton in the industrial complex that play into building out the ability to store and generate power, we think very attractive. Counter-cyclical stocks, and stocks that are more value or recession resistant in nature. So stocks like Dollar General, the trade down, Kroger, a grocery store chain, which is about as far away as you can get from AI as you can think. Uber, if you go to a city, I travel all the time to different markets within our firm and have to talk about market outlook. I always catch an Uber or, Uber Eats. We got to eat, so AutoZone, as we extend, maybe spend a little bit less on new cars. We need equipment in the aftermarket. And so those are just, some examples of stocks that I would, kind of throw out there.
Jeff, it's great to get your take. Of course, a lot to digest here as we see the market respond to events happening, of course, around the world, but also economic activity here in the U.S. That's Jeff Krumpelman. He's a chief investment strategist and head of equities at Mariner Wealth Advisors, joining us from Cincinnati. Jeff, thanks again.